So in this lecture, I would like to talk about second generation foreign exchange crisis models, and we will talk about self-fulfilling expectations. So foreign exchange crisis models developed over time. When we talk about a first generation crisis model, it is the case that we are looking at one economy which has a bad macroeconomic policy in place, and the macroeconomic variables deteriorate over time. The crisis will occur with the likelihood of 100% when this bad macroeconomic policy is not changed at all. Nevertheless, what comes to some extent as a surprise is the point in time when the crisis occurs. So the point in time when the crisis occurs is surprising. In a second generation crisis model, it is the case that a crisis might occur or the crisis might not occur. It depends. It depends on what? It depends especially on the expectations which are formed by the financial agents. When the agents believe the system is stable, the system will be stable. When the agents believe the system is unstable, the system is unstable. What about a third generation crisis model? In a third generation crisis model, it is the case that a crisis on the foreign exchange market leads to a crisis in the whole financial sector. So also the banking sector is in a crisis, and the banks do not finance companies and their investments anymore. The demand for investment goods breaks down, and hence in the end what follows is a real economic crisis. So the crisis on the foreign exchange market leads to a situation where GDP decreases or GDP collapses. This is different in a first generation crisis model, for example, because of the fact that this crisis only takes place on the foreign exchange market. Only the foreign exchange market is affected and the exchange rate changes, but it has more or less no implications for the real economy. This is different in a third generation crisis model. So let's talk about the assumptions of our second generation crisis model. We are looking at three different players. The central bank is one player, and then we have two speculators. The central bank wants to defend the fixed exchange rate, which is normalized to the ratio 1 euro for 1 US dollar. The central bank has reserves of the quantity R, and the central bank intervenes until the reserves are equal to zero. When the reserves are equal to zero, the fixed exchange rate system will break down, and the central bank will switch from a fixed exchange rate system to a floating exchange rate system. When the exchange rate system breaks down, then the new level of the exchange rate will be 1.5 euros per US dollar. So we observe a huge increase in the exchange rate, which is a depreciation of the domestic currency, the depreciation of the euro. Each player has a portfolio of 6 euros, which can be held by the investor or exchanged into dollars. In case that one player opts to switch from euros to US dollars, this player has to pay transaction costs of 1 euro. In the following, I would like to perform a scenario analysis, and we will go through three different scenarios, scenario A, B, and C, and all scenarios vary with respect to the reserves of the central bank. We'll look at scenarios with high reserves, with low reserves, and with intermediate levels of currency reserves in the cellar of the central bank. Let's have a look at the first scenario, scenario A. The central bank has high reserves of 20 US dollars. In case that both investors, like both players, hold, nobody wins, nobody loses, the payoff will be equal to 0 euros. If one player holds and the other one sells, the seller will exchange 6 euros to 6 US dollars. The reserves of the central bank are down from 20 to 14. The exchange rate system will be stable because reserves are not equal to 0. The seller has a burden of €1 transaction costs, so the payoff for the player who is selling will be a negative €1. In case that both players sell, both players will exchange 6 euros into 6 US dollars. The reserves are down from 20 US dollars to 8 US dollars. The exchange rate system will be stable, but each player has transaction costs of €1, so the payoff is minus €1 for each player. The further assumptions are as follows: that we are looking at a non-cooperative symmetric game. Both players move simultaneously, and we have a game without repetition. So you can see the payoff structure in this table. In case that both agents hold their euros, then there is no loss or gain. For both of the agents, the payoff is 0-0. If only the black agent sells, then his payoffs are down because of the transaction costs, while the red player doesn't incur any cost. Same in the right upper cell, because of the fact that the game is symmetric, payoffs will be 0 and -1. And if both players sell the asset, then it will be the case that both players have transaction costs of €1. Therefore, this payoff is -1, -1. But the exchange rate system will still be stable because the central bank has very high reserves. So what is the outcome? What is the Nash equilibrium here? The Nash equilibrium is 0-0. In case that, for example, agent 2 plays the hold strategy, the black player has to compare the black 0 with the black -1. The black -1 is lower, so there is no incentive for agent 1 to change this behavior. Therefore, the upper left cell is a Nash equilibrium. We could also ask, for example, why is the right lower cell not a Nash equilibrium? Let's assume that agent 2 plays sell and agent 1 also plays sell. Is there an incentive for agent 1 to change the strategy? The agent 1 has to compare the -1 with a 0. 0 is higher, and therefore agent 1 will change his strategy in case that agent 2 plays the sell strategy. So in case that agent 2 plays the sell strategy, agent 1 will play the hold strategy. Therefore, the right lower cell is not a Nash equilibrium. The conclusion is, in scenario A, the exchange rate system will be stable. So in case that the central bank has very deep pockets and has a lot of reserves, then the foreign exchange rate system is stable. Even when the two agents are speculating against the central bank, are speculating against the fixed exchange rate system, the central bank has enough reserves to intervene at the foreign exchange market and has so deep pockets that the central bank is able to defend the fixed exchange rate system. Let's switch to scenario B, where we look at a scenario where the central bank has low reserves and the reserves are equal to 6 US dollars. When both players hold, nobody wins, nobody loses. Payoff is equal to 0. In case that one player holds and the other player sells, the seller exchanges 6 euros to 6 US dollar. The reserves are down to 0. The fixed exchange rate system breaks down and the new level of the exchange rate is 1.5 euros per US dollar. After the breakdown of the fixed exchange rate system, the seller can once more exchange the 6 US dollars into 9 euros. Therefore, from this transaction, the seller will make a profit of 3 euros. We also have to think about the transaction cost of 1 euro, so that the payoff is a positive 2 euros. In case that both players sell, both players exchange 3 euros to 3 US dollar, and 3 euros are kept denominated in euros. Of course, both agents would like to exchange even more, but the reserves of the central bank are limited. The reserves will be down to zero, the exchange rate system breaks down, and the new exchange rate level is 1.5 euros per US dollar. After the breakdown of the fixed exchange rate system, when the new exchange rate is in place, each trader can exchange 3 US dollar back into 4.5 euros. So each trader has to pay the transaction costs of 1 euro, and each trader has a payoff of, or in the end, the trader has a wealth equal to 3 euros. These are the initial 3 euros which were not exchanged into US dollar. Then the 4.5 euros, these are, or this stems from the transaction. The player is exchanging 3 euros into $3 at the exchange rate of 1. When the exchange rate system breaks down and the new exchange rate is equal to 1.5, then the 3 US dollar can be exchanged into 4.5 euros. So these 4.5 euros stems from the foreign exchange market transaction. And then we have transaction costs of minus 1 euro. So the trader ends up with 6.5 euros. We have to consider that each player started with 6 euros. So the net gain of this transaction is 0.5 euros for each player. How does that look like in our payoff matrix? In case that both players hold, the system is stable. In case that both players sell, then the system is unstable and the payoff will be 0.5 euros for each agent. This is the net gain of these transactions. And in case that, for example, agent 2 holds, the payoff for agent 2 is equal to 0. And if agent 1 sells, then it is the case that the exchange rate system breaks down and the payoff will be equal to 2 euros. So here in this scenario B with low reserves, it is the case that already the actions of one agent are sufficient to change the exchange rate system. So even when only one agent is speculating against the central bank has so low reserves that the central bank cannot defend the fixed exchange rate system against a speculative attack. So what is the outcome here? What is the Nash equilibrium? Of course, the right lower sell is a Nash equilibrium. Therefore, we know that in scenario B, there is a very high likelihood that the exchange rate system will break down and both agents will speculate against the central bank. Why is the left upper sell not a Nash equilibrium? Let's assume that agent 2 plays the hold strategy. Does agent 1 have an incentive to switch from the hold strategy to the sell strategy? Yes, because the payoff will increase when agent 1 changes the strategy. Therefore, the upper left sell is not a Nash equilibrium. Let's have a look at the most interesting scenario, scenario C, with medium reserves. The reserves in the cellar of the central bank are equal to $10. In case that both players hold their money in euros, nobody wins or loses, and the payoff is equal to €0. In case that one player holds and the other player sells, the seller will exchange €6 into $6. The reserves of the central bank are down to $4. The exchange rate system is stable. The seller will exchange the $6 back into €6, and the seller pays the transaction costs of €1. So the payoff is equal to a negative €1. What happens in case that both players sell? The central bank has only $10 in reserves, so both players can exchange €5 into $5. €1 is kept denominated in euros. Both agents would like to exchange even more, but the reserves are limited. The reserves are down to 0, and therefore the exchange rate system breaks down, and the new exchange rate level is 1.5 euros per dollar. Each trader exchanges $5 at the new exchange rate back into 7.5 euros, and each trader pays the transaction costs of €1. So in the end, the trader has a wealth equal to €1, which were kept in euros because the central bank didn't have more reserves. 7.5 euros. This stems from switching €5 into $5 at the exchange rate of 1, and then switching back the $5 at the exchange rate of 1.5 into euros. So this is the second component, and then the last component, the -1. These are the transaction costs. So in the end, the trader ends up with 7.5 euros. The net gain is the 7.5 euros. We subtract the €6 the player started with. So the payoff is equal to 1.5 euros for each player. So this is the structure of the table. And now we can check whether, for example, hold, the left upper part, is a Nash equilibrium. Let's assume that agent 2 plays hold. Is there an incentive for agent 1 to switch from hold to sell? Agent 1 has to compare the black 0 with a black -1. The black -1 is smaller, so agent 1 has no incentive to switch from hold to sell in case that agent 2 plays hold. Since the game is symmetric, this line of argumentation also holds for agent 2. The upper left cell is a Nash equilibrium. We can also check whether the right lower cell is a Nash equilibrium. Let's assume that agent 2 plays sell and agent 1 also plays sell. Is there an incentive for agent 1 to switch from sell to hold? No, there is no incentive to do that, because else the payoff would decrease from 1.5 to 0, and therefore there is no incentive for agent 1 to change the strategy. The right lower cell is also a Nash equilibrium. What about this cell here, like the left lower cell? Is that a Nash equilibrium? Let's assume that agent 2 plays hold and agent 1 plays sell. Is there an incentive for agent 1 to change the strategy? Yes, there is an incentive to change. It's not the best response. In case that agent 2 plays hold, then the best answer of agent 1 will not be sell, but the best answer is to also play hold, and therefore the left lower cell is not a Nash equilibrium. Also, the right upper cell is not a Nash equilibrium. So the solution is that we have two Nash equilibria, the upper left cell and the right low cell. The upper left cell, there the exchange rate system will be stable in case that both agents hold their assets in euro. Then no crisis at the foreign exchange market occurs and the exchange rate system is stable. In case that both agents sell, then the exchange rate system is unstable. The central bank will run out of reserves and the exchange rate system will switch from a fixed to a floating exchange rate system. Let's conclude. In scenario C, we have two Nash equilibria. So we have multiple equilibria. The expectations of the investor determine which equilibrium will be reached. So we have self-fulfilling prophecies here. Self-fulfilling prophecies imply when the investors expect the system to be stable, the system is stable. But when the investors expect the system to be unstable, then the system will be unstable. Furthermore, one additional insight is that when the expectations of the financial agents change from no crisis to crisis, without any further change of important observable macroeconomic fundamentals, the exchange rate crisis can fall from heaven. So it is suddenly the case that we have a switch in expectations. I don't know why this is the case. It might be the case that we have a rainy day, bad weather, windy day, and therefore the investors are depressed and the expectations in the head of the investors switch from no crisis to crisis. Nothing has changed in the macroeconomic fundamentals. So it's not the case that one country has a higher inflation rate than the other, or a government came up with the information that the government budget is in red ink and has a larger deficit than expected. So the macroeconomic fundamentals are stable, but the currency crisis falls from heaven. So there is no change in observable fundamentals, but the crisis occurs because expectations have switched. These are the main conclusions of this chapter. And in the end, I would like to ask a question you could all think about. So how important are our assumptions? We had three important assumptions about the game. We have a non-cooperative symmetric game, we have simultaneous moves of the two players, and we have a game without repetition. So one question could be, what happens in scenario C when we relax the assumption of a simultaneous game and we switch to a sequential game? Is it the case that we still have multiple equilibria, or is it the case that we only have one clear-cut solution for this game? This assignment is on your side. Thank you very much for having you with me in this lecture about second-generation crisis models and self-fulfilling expectations. Thank you.